Bonjour and good afternoon, everyone. Welcome to this session where we'll be looking at how to finance emerging economies, how to unlock private and public financing. I'm Talya MISIRI and I'll be hosting the session today. But to start, I would like to ask my panelists to introduce themselves and to give a quick introduction to their role and their firm. So Henrik, perhaps I can start with you.
Thank you. My name's Henrik RABER. I'm head of global banking at Standard Chartered. And one of the key businesses within global banking is infrastructure. We've obviously been a leader in the infrastructure space in emerging markets for the last 3 to 4 decades. So very much look forward to the conversation.
Great, thank you. And Sultan, hi.
Thank you, Henrik, and thank you, Talya. Good afternoon, everyone. My name is Sultan AL-ABDULQADER. I'm part of the infrastructure finance team within HSBC Saudi Arabia, who kind of works heavily within the infrastructure projects and the key transformation of Vision 2030 in Saudi Arabia.
Good afternoon. My name is CEUSTERS. I'm a director at Treasury at an MDB with a 3-letter acronym that is apparently very bureaucratic. So.
Hi, I'm David SYED. I'm a lawyer at Dentons. I head the Sovereign Advisory team, and I don't have any acronyms, sorry.
Fantastic, thank you all. So keen to get stuck straight in. Let's perhaps set the scene and see what kind of the kind of emerging economies are doing in practice. So Henrik, perhaps you can start us off. How can emerging economies build financing architectures that both attract public and private capital?
Thank you. Well, I think the emerging markets have successfully already building partnerships, both with the public and private sectors over the last 2 to 3 decades. There's obviously been a huge need for financing in the EM space, from power all the way through different types of infrastructure. That's had solid success and increasingly is attracting more private capital into the region. But even since we met at this conference last time, there's been quite a lot of change within infrastructure, notably the advancements in AI and the demands around data centers or power. So I think increasingly the emerging markets also need to be cautious of that there's not crowding out. There's a lot of demand coming from the European and US infrastructure projects, which are also very attracting returns for private investors. So I think it's a balance, and I think the emerging markets are acutely aware of this. They're working with partners, but it's not only partners with ECAs, which have been incredibly successful, or agencies in Washington or elsewhere, or here in Paris, which has led a lot of transactions, but it's also partnerships with the private side, so partnership with banks. So I think there's going to be a lot more collaboration going forward, and that's going to be needed to harness the amount of capital that's needed.
Certainly, and we'll come on to the partnerships and discuss that in more detail a bit later. Thank you, Henrik. And Sultan, from your perspective, what are you seeing kind of in Saudi? What can you share here?
Yeah, so when we talk about strategic infrastructure, I think it's important to take a kind of a step back and just say that infrastructure isn't about airports and power plants. It's the platform that kind of pushes everything else, right? So it's what allows economies to diversify, to become more productive, and actually unlock new industry and technology, right? So the big challenge is, how do emerging economies kind of develop financing structures that kind of both attract public and private capital, as well as doing it in a resilient and sustainable way, right? So I'd frame it around 4 main pillars. So the first one I would talk about is clarity of vision and regulation and policy. So naturally, capital follows clarity, right? Investors want to know that there is a long-term plan, there is consistent regulation and predictable policy. Where governments kind of provide a clear roadmap to investors, that's where confidence increases, and confidence increases dramatically, right? The second thing that I want to talk about is more about project preparation. So in my field, investment banking, we often say that there is no shortage of capital for infrastructure projects. What we kind of tend to see is the lack of bankable projects. What I mean is we need projects that have credible feasibility study, reasonable risk allocation, and standardized documentation that are adherable to everyone, right? And if governments and sponsors engage with financiers at an early stage, I think the whole process becomes faster and more efficient. The third pillar that I wanted to talk about is about how to utilize public capital to kind of incentivize private sector investment, right? So governments and development funds typically are able to kind of deploy their funds strategically. So these tools that they currently have are guarantees, insurance, political insurance offered, and first layer of risk being taken by them. So in this situation, it allows private sector developers to come in and invest in emerging economies, right? The intention isn't for the public sector to do everything, it's to utilize their capital in a way to unlock a much larger pool of private capital into the market. And finally, I think I overspoke. I just want to cover one last point, is the need to develop local capital markets. Long-dated or long-term infrastructure can't just rely on international or foreign banks and DFIs. Countries that develop strong local bond markets and also attract infrastructure investors such as pension funds and insurers typically provide a much more resilient ecosystem that is sustainable over a period of time.
Yeah, certainly. That's a great roundup. Thank you, Sultan. And yeah, agree with majority of that. Certainly when it comes to the partnerships and the government buy-in as well, and also having that kind of local presence and local backing is definitely important too. Tom, do you agree? And I didn't plan to go down the line like this, but you've all sat in order.
No, I fully agree, and I think although we didn't collaborate or cooperate, I think you stated it very well, what I was trying to say. And I'm going to reframe it in the context of what the World Bank is trying to do in IFC at the World Bank Group. The need for capital, all the pillars that are needed to make this happen. On the background of that you need to know that 80% of the population in 30 years will live in what is now categorized as developing countries. 1.2 billion people will enter the workforce in the next 10 years. So, unemployment, is a major driver of, poverty, political instability. So that's what, since we have a new president 2 years ago, Ajabanga, a whole strategy is focused around creating jobs, because it's the major driver of economic development, decreasing the poverty and increasing prosperity. And that what I was going to say is more or less aligned with what Sultan said. We have three pillars on. You need to build the critical infrastructure, roads, ports, but then also education, because I talked about the people entering the workforce. It's human capital in countries where there's a high potential of minerals and fertile ground. So education, healthcare also, because you need a healthy workforce. So critical infrastructure, talked about that. Second pillar, you framed it already, is certainty and transparency with regard to entrepreneurship. Policy, regulation needs to be clear, transparent, and you need to have a visibility on that as a second pillar. Third pillar is bringing in the private sector. 90% of jobs are created in the private sector. So our whole strategy of the totality of the World Bank Group has been refocused on the private sector, creating these jobs and bringing in the capital. And we can elaborate on that one later on, but making that a business-friendly environment. So policy reform, private capital enablement, and then mobilization, bringing in the private sector. And I'll come back to that one on risk mitigation, based on risk mitigation, and also bringing co-investing with the MDBs at first, for a later stage to go into it yourself. And then we do a lot of research on risk perception, but I'll come back to that on that one.
Fantastic, thank you. And coming to you, David, so we've clearly set the scene very well. But from your perspective, kind of coming back to this idea around partnerships, so what roles should development banks, sovereign funds, institutional investors play in bridging the gap between both project ambition and bankability of those projects?
Thank you. No, I mean, it's been pretty well covered, a lot of the issues. But here, I think you're bringing another kind of point of view, which is how do people work together? Well, and it's not just about working together, it's about stages, right, in a project. And it's stages in a project, and it's different levels of development in different countries. So it's horses for courses. There's no cookie cutter, one size fits all solution, but there are different solutions that can be brought together in different ways in different places. So I think just to answer kind of at a generic level, right, always taking into account that I'm always very skeptical of being overly generic because I think every country and every situation is different. I think on a generic level, first thing is de-risking, right, and project preparation, and that can be very well handled by people like multilaterals, development agencies. There can be specific funding set aside. There can be sharing of information and pooling of resources. So there's a lot of things that can happen to help project preparation be more effective so that it's not just a project one is looking at, but a pipeline of projects of a similar nature, right? Because that can be then taken to market. In terms of sovereign funds, I think sovereign funds have a strategic purpose, right? I'm not saying that the multilaterals don't have a strategic, but it's kind of a global strategy, right? Sovereign funds have a specific strategy, which is to serve the interests of their country, right? Or their region. And I think what sovereign funds can really bring to the table is resources in terms of becoming anchor tenants, effectively. And they can take levels of risk, and also they can take maturities and time frames that other investors cannot take. So I think that's very, very useful. And then we come to the other players in the market, which can be bilateral financing institutions, commercial banks, bonds, capital markets. But that will be much better served if all of the steps before have been properly accomplished. Always with the idea of going to pipelines and not just one-off projects, if possible. I mean, there's some projects are so huge that they need, one-off is perfectly okay, but in general.
Makes sense, great. Henrik, I see you nodding away. Is there anything to add there?
Well, I think on many of these panels and over many years, there have been the same sort of initiatives and positive intent around trying to solve many of these challenges. And whilst the cadence has improved, not huge headway has been made on some of these points. So developing local capital markets. If we look at Asia infrastructure, 55% is in Australian dollars. The 25% or more is in Indian rupee. That means there's actually very little local currency going on in the rest of ASEAN or other major countries. The bankability of a project or the transferability of a loan to create more balance sheet velocity, both at the multilats and the banks, has continued to make progress, but maybe not at the progress we've all wanted. Many of us are running initiatives around originate to distribute, balance sheet velocity, and so forth. And there continues still to be challenges around that. So there's great intent. We talk about it. Everyone's trying, but we still haven't really cracked the code around this. I think the thing is it could become even more important with AI. So with AI, power is going to be crucial. Power is actually going to lead to knowledge. So if we don't resolve, for example, power within emerging markets on scale, that the quantum that's now needed in the future, the EM countries potentially will have it more challenging than better in going forward. So there's a lot of real issues that still continue, but the big currencies are still the major financing tools. We would love to do more in local currency, but there have been challenges around returns and where private credit, et cetera. So there's still many topics. So we want to do more, we'd love to do more, but we still haven't fully cracked the code.
Do you have any ideas on how we can do that?
Well, I think some of the structuring that's going on the last couple of years around first loss structure, slicing the capital structure so it fits better for banks, investors, private credit, has really moved the argument significantly forward. I think some of the credit insurance and credit guarantees are now available. Look at some of the work that's being done at MIGA, for example, is very beneficial. So I think the mindset across all participants is opening up to find new structural solutions around how we manage the risk and also create the return profile that investors want is going to lead to more capital flowing into emerging markets.
Now, if I can pick up on that, it's certainly one of the dilemmas we're dealing with because, as I explained, a drive to mobilize, what we call mobilize private capital, and also our other goal of finance in local currency. And depending on what you finance, because obviously if there's minerals or whatever, you have dollar revenues, it's fine to do a dollar loan, but SME financing, which is a very strong driver of jobs, infrastructure, we prefer to do local currency, but that clashes because you can only mobilize in hard currency. So that's a dilemma, certainly, that we're dealing with. And we're trying to look for solutions. And certainly slicing, one of the things we did and we recently announced was IFC's EMS program, Emerging Market Securitization. There were some attempts before, but this was really what we figured a start of a new asset class. We issued a CLO, 510 million. 320 million of senior tranche, AAA, 130 over SOFR, so very attractively priced, I would say. Mezzanine tranche of 130 million, and then an equity, a junior tranche of $60 million. So that is part of a program that we'd like to do and come back with the market to create that asset class, recurring issuance, so size, because if you go and talk to the people on the West Coast of the United States, $500 million doesn't cut it. So we need to come with a program, regular issuances, and then we go back to the origination, which is what we talked about, bankable products and all of that. That's actually still our biggest challenge, the origination. So we're picking up.
I just said, I think that's an excellent point, that securitization, whether it be CLOs, ABLs, or different formats around that, is very much going to grow. There are different views around securitization, and in Europe we have much stricter rules around securitization than you do, for example, in North America. But that is one way that can really mobilize capital, and I think we all need to get more comfortable with securitization and developing that route more.
Yeah, picking up our issuance was not ESMA compliant, so because it was way too difficult to comply with the rules.
Hopefully it'll become easier. And then kind of moving on in terms of, we've touched on risk, but Tom, I'll come back to you first on this one. So in what ways can regional partnerships and cross-border coordination enhance investment pipelines and improve risk sharing for large-scale infrastructure projects?
Yeah, I obviously risk sharing already with the CLO already touched upon. Well, the point I wanted to make also is this is the third year in a row that I've been on a panel here. 2 years ago, I announced that we, under the pressure of our shareholders, and we had a capital adequacy framework review, they said, you need to open up your databases. So I announced that 3 years ago. Last year, we actually launched it. And now we're in the third year, and it's the impact of what we call our GEMS, Global Emerging Market Database, has gone way beyond what we imagined initially. So for those who are not familiar, consortium that was started by IFC and EIB in 2009 has grown to 29 MDBs and DFIs that group their credit data and history, initially for our own purposes, to calibrate our own models, but this has grown to a 30-year database of data that we now make public. And we put a lot of time and effort in. We did surveys, we took feedback, And now it's available on Bloomberg with a ticker. Each number has a ticker. We working together with a data integrated, or letting AI loose on it. But the conclusions of that is that there's a big misperception in terms of risk. And the two numbers that you need to retain are probabilities of default, private sector, emerging market, 3.5%. Recovery rate, 72%. I always put an asterisk behind that because these are numbers of MDBs, where it's not subsidized, but in a way it is, because IFC, for example, we have 105, we're operating in 105 countries. So we have boots on the ground, we have somewhat preferential relationship with the governments, but that costs us a lot of money. Just the cost of doing business is very high, but that reflects itself in a much lower loss on the credit side. And then second of all, if you go to the website, you'll see that there's a lot less correlation when there are crises, whether it is 2008, COVID, the defaults were much less than in the developed world. So in terms of portfolio construction, it's a really good tool to make that portfolio more resilient if you integrate emerging markets in your portfolio. And so that's one of our bases that we use to start producing products. As I said, the CLO is one of them, and we have multiple others. IFC, we were at $1 on our own balance sheet, $1 from the private sector. We moved up to $2 last year. We did $24 billion on our own account. We had $48 billion that we brought in from the private sector, just for IFC alone. Our goal is really 1 to 6, 1 to 7. And talking about the CLO, we retained the mezzanine, but we got insurance from insurance companies, and we retained half of the junior tranche. Our goal is really to keep only 5% of a vertical tranche, such that people know that we are in the deal, but the rest is mobilized, and then you get to 1 to 19. If you are $100, we keep 5. 95 comes from somewhere else, so that's 1 to 19.
Oh, significant. How have you managed to get that buy-in? Is it a result of track record? What's kind of encouraging people?
Well, as I said, the data is there. We did a lot of work on the data, obviously, and I must say it's the momentum also. The dollar, the weakening of the dollar. And I am also responsible for issuing all the AAA debt of IFC. We've seen a lot of traction on emerging market currencies, but it's still only the currency play. They use our AAA to not take any credit risk, not go onshore. It's all offshore. But I think there's a lot of traction on that. And the CLO being very successful was just a continuation of that momentum.
Well, I think the whole structured credit space has also grown significantly. So you have the banks doing SRTs in ever larger volumes, you have cash CLOs, you have ABS. There's lots of different tools coming off the bank balance sheet as well, now coming off the official institution side as well. And the investor education and the appetite for these products has gone up significantly. And the returns have actually been very good. For those who've invested through the cycles in a CLO fund or an SRT exposed fund, they've actually done well. And it's an arguably maybe a bit of a diversified return towards your equity portfolios or other things. So there's a lot of benefits. There's a whole piece here also about education. The more that financial institutions are educated and investors, the more comfort there is in these types of products, and the more we move forward. And this was a great transaction. I think you've done it. This is the second one. I think there was one way back in the 90s. So it's taken us 25 years odd to get the second one. We look forward to the new one.
Yeah, well, that was done with the goal of liberating the balance sheet. This is, for us, as I explained, this is not for making space on IFC's balance sheet. It's really to bring in the private sector, and the whole product was designed with that goal in mind. But coming to your point, I deal with all the big banks, and whenever we have these conversations with them, and we're always discussing, and they always were saying like, Tom, we're in the moving business, we're not in the storage business. meaning they never use their balance sheet in emerging markets, where we're saying, it would be nice, but I always say the last couple of years, we've clearly seen a shift. Even like big American banks are opening up to this space. And as mentioned, it's about education and getting to learn and getting familiar with the underlying risk, and coming to the conclusion that the risk is not as bad, not even close as bad as it the perception was always. And that was a recurring theme here. What you see is in the news, what gets to the news is always the bad news, the coup d'etats or whatever, which is like 0.2% of the total GDP of a region in Africa. But that's what gets to the news, and that's what creates perception. More and more professional people are getting over that and seeing the real benefit. Another thing that comes out of the GEMS database, the corporate probabilities of default and all of that are much lower than what the implied LGDs and PDs are from the rating of the sovereign, because the sovereign has a lot of the political instability built in, the effects, and then also the rating agencies just have don't have enough resources to put a proper rating on. So all of that is changing, and the momentum, as mentioned, is clearly there. So
definitely. So it's definitely a positive outlook. Things are improving with education and more awareness. Sultan and David, I'll come to you as well on this in terms of kind of your thoughts on risk sharing. Perhaps, Sultan, could you share your views from HSBC's perspective? Yeah,
so my experience isn't as broad as Henrik and Tom when looking at multiple economies. But so what I typically see with regional collaborations is understanding what are the best practices that we've seen in other economies. We look at what are the key aspects to kind of really focus on, what is kind of more is acceptable to our regional environment within Saudi, for instance, or within the wider GCC economy. And that helps the bankability of transactions kind of transition forward, or to kind of sometimes push the lender's market to kind of take a bit more risk. So naturally, at the beginning, we become a bit more conservative, right? We do say some foreign banks' involvement in Saudi Arabia, but typically what they tend to do, as Henrik kind of mentioned, is originate to distribute, where within the next 6 or 8 months window, they tend to kind of sell down to other economies or other financial institutions. What we're seeing is there is a slight shift where these timelines are slightly increasing over time, where foreign banks are getting more and more comfortable with taking on certain risks, but this only is underpinned by how well they know that economy, how well the transaction is actually structured, so bankability is a key aspect, and of course the political aspect of that economy as a whole.
Certainly.
No, I agree. I think just to take a step back, what we're talking about here is bringing liquidity but also bringing throughput, right? In other words, things don't get stuck. And to do that, you need to have, a legal framework, a structure, a contractual framework, people buying into it, understanding it, and using it. But I think just a couple of points maybe. So all that's very, very good. It's all very positive, and it's going in the right direction. I totally agree. And what we're seeing more and more also is major infrastructure projects in the developed world, for example, data centers, et cetera, in terms of the whole digital transformation. So, but I think where there's still work to be done is collaboration between different, geopolitics is getting in the way to a degree of, I think, even further collaboration. Because what we're seeing now, see, I'm looking at it from the sovereign perspective. I'm talking to governments at different stages of development, from, absolutely, kind of first stage financing to highly sophisticated multiple bond issuers, right? So, and it's very different. The sophistication, the understanding, and also the market access and possibilities. So I think it's really important to get also products for the less easy, let's say, credits, so that they still have access to development finance and are able to actually fulfill the political and policy goals of the governments of those countries. So I think that's an area to focus on. I think another area to focus on, but mutualization helps that, right? It does, definitely. And another area is to try and find ways for some of these geopolitical, I'm sure at the World Bank and others, you see it, right? We see it in debt restructurings, where China has one position, let's say the international community has another, I don't like that word personally. But let's say, Western creditors have a different position. The bondholders, and the, official sector have also different positions. So I think there's a necessity of finding bridges and ways of working better together to bring even more fluidity to the processes.
Yeah, definitely. I think there's so many opportunities to be unlocked, but as you said, there perhaps are those barriers between certain geographies or certain kind of jurisdictions that I don't know, is it a case of timing? Is it a case I think there's always going to be challenges. What's your opinion?
I don't think it's a matter of timing. I think it's just addressing the issues and finding. Timing is important when you have a restructuring. You need X, Y, Z at a certain moment, and everything has to converge. Otherwise, it's like a domino effect, right? It goes positive or negative. If you don't have every piece in place, it can't happen. But I don't think that's the issue, really. I think the issue is more having the appropriate platforms to share data. I think is okay. I think it's improving. I think there's still a lot to be done to get data from certain parts of the world into the system. But I think it's more having the platforms and having structures in place which are predetermined, so we don't have to do ad hoc every time, because that's very complicated.
So I would very much agree with that. And I think within that structural point is hedging, so credit hedging. And I think one of the positive developments we're seeing around that is credit insurance. So in the 90s, you saw a huge growth in credit derivatives, predominantly off CDS or other types of structures. We can view that as being successful or not, but it did create a lot of growth and capital deployment, obviously with the challenges around it. But increasingly in emerging markets, what we see very successful is actually buying credit insurance, like a traditional insurance contract you'd buy from an insurance company. And that can hedge very specific parts of your risk. Obviously, political risk cover has been out there for many years, but increasingly also hedging specific project risk. I think this is going to be a huge growth in the market that we're going to see over the next decade. We do need more entrance into this because it's currently quite concentrated with the range of insurers. But as was touched upon with IFC, et cetera, using these products in the back, enabling credit insurance or another as a better form than we've seen in the derivative markets can really help, because you're hedging very bespoke project, country, credit risk, contractor risk, all kinds of risks. And that, I think, is going to be a big piece of the framework going forward.
Really interesting. I mean, do you think that will be something that we see develop kind of top down? So kind of the larger banks, funds, institutions will adopt that kind of insurance first?
So I think it's a great point. So obviously the larger players, larger banks, larger institutions are already using credit insurance quite actively. So we need to spread that and make it a lot more broader. We also need to make some changes around credit insurance. So credit insurance today is a bilateral effective contract, which you can't trade or you can't move the asset with the credit insurance, which is a real hindrance to balance sheet velocity, et cetera. We will get there. But to your point, we do need the credit insurance to move down the capital structure and broaden out. So there's more countries that have access to it, more projects, more institutions. Like any market, it's going to take a time to get going. We see the volumes every year rising, and I think this is going to be a really exciting part. And there's so many global insurance companies out there that many should be able to play in this. And it's also, to your point around, if you actually look at the defaults or the actual number of contracts that get called upon, it's actually very high returning, good product to invest in.
Yeah.
No, I think I think you make a good point, but it's about scalability of the product. And if you read, MIGA has been talked about in the previous panel. You'll probably all know what MIGA does, but a lot of his stuff on MIGA's balance sheet is reinsured. So there is a clear appetite for that, but it's obviously not enough. but there's a clear appetite for that because it fits their needs in terms of unfunded long-term products that have a nice return and are uncorrelated with the rest of the market, the developed market or not. And one tangible product that you might have read about, you've seen the hurricane in Jamaica last week, 2 weeks ago. $150 million is going to be paid out to a cat bond that was issued by the World Bank and was fully insured by insurance companies behind the scenes. So they have that appetite to take $150 million of hurricane, and that was a deal that was done last year, a rollover of a deal that was done 3 or 4 years ago. So the appetite is there. I think to the point of Henrik, it's just a mechanism to make it flow, and that will take time, and it will come eventually, and everybody is contributing to that. So seeing large evolutions over the last couple of years.
And there's going to be new risks as well. I mean, as the world changes, there's going to be a whole bunch of new risks that are going to have to find their own insurance cover. So it's going to be very, very important, but quite a moving target.
Definitely.
Climate is one of them.
Yeah, definitely. And David, I want to stick with you on kind of the last topic. When it comes to project preparation and scalability, obviously many projects never really make it past the preparation stage. So what's missing in the project pipeline? Is there anything to add from what we've discussed today? And what's needed to move more projects past that to the kind of initiation stage to financial close?
Yeah, well, it sort of takes us back to the initial point, because obviously at the output, we're talking about, securitization, et cetera, but you got to get the projects into the pipeline to start with, right? So I think probably the most important thing is like boots on the ground and people that are actually focused in coordinating, probably at a state level to start with, if not a regional level, to make sure that, number one, that it's priority projects, number two, that they're projects that fit the criteria, 3, that they're properly prepared. In other words, legally, obviously I was a lawyer, I always have a tendency to look at the legalities of things, but it's not just legal, it's the whole framework. The financial viability, the regulatory framework, that there's political backing for the project as well, that it's not just the idea. And to do that, you also need coordination. So a lot of countries have put together, I've worked in a couple of them, these PPP kind of units, et cetera, that bring the ministries together, that try to kind of become the experts, right? They're the experts to the government, right? And to the different, also the regions within a country, so that they can get good projects properly prepared and bring them to the table. I think that's probably the most important thing at the grassroots level, is to actually get the information and the proper preparation. So I'll stay with that.
Well, we have a lot of projects that get hung up in planning applications, this sort of document processing, unfortunately. I think if globally, and I know it's a sort of large wish, if that piece could be expedited, a lot more projects would be coming online and coming on time.
I totally agree. And something that, you need a real coordination between the international community and also the local. And that's where the hitch can be,
Great. I see we've only got a couple of minutes left, so I've got one final question for all of the speakers. And we've discussed a lot today, and without repeating too much, I'm intrigued to understand from your perspective, what is the one key factor that you'd like to see change or improve to enable kind of the financing of emerging markets and infrastructure within them? Henrik, can I come to you first, put you on the spot?
The key is obviously releasing more capital into these markets. So I don't think there's one silver bullet around that. I think there's several things that needs to be done. But, we're incredibly excited about infrastructure finance, both globally and in emerging market. It has become probably the most exciting area of finance, and that's also with the development that's coming behind it. So we've touched upon a few things already. If we could just get one or two of the things we've discussed this afternoon, we'd be making much stronger headway than we are now.
Great. And Sultan?
So if I had to think about it, I think I come from an economy that's still evolving and emerging, right? And we tend to see projects that are very well bankable and projects that aren't that much there. So I would kind of really think about project preparation as an important aspect. I think, Henrik, you did mention that there are some projects that do quite a lot of pre-feasibility, but the documentation doesn't get there. I think it's important for economies and government entities to kind of look at standardization of these documentation, where the best practices that are available within the region, they don't have to be global. Regionally, given that they've accepted in economies right next to you, it might be as a good starting point for it to kind of go through.
Great, thank you.
No, all the points were mentioned. I would pick the one, risk perception. If that keeps on improving, it will facilitate everything else, because if people will continue to educate themselves, capital will be flowing in, documents will be standardized, because otherwise you can't do the mass, origination and distribution. So I would say the perception.
Yeah, great.
So I agree with everything that was said by my colleagues here, and I can give the politically correct or incorrect answer. I'm going to give the incorrect one, just to close. I think taking ideology and politics out of infrastructure financing, I think human needs are global, and whereas we can all have our political and ideological ideas of what and how countries should be run, I think we need to take that out of the system a little bit and work together more to achieve common objectives. So.
Here, I agree. Fantastic. So to summarize, we've got a greater access to capital, project preparation, standardization of documents, improving risk perception, and taking ideologies and politics out of it. And let's all work together and finance the emerging markets. Panelists, thank you so much. Please join me in thanking our panel.